Welcome to the deep dive. You've given us the sources on Cintas Corporation, that's ticker CTAS, and their latest quarterly results. Fiscal 2026 first quarter, ending August 31st, 2025.
Right.
And our job today, well, it's not just to read you the press release. We want to give you a really efficient, insightful look at what drove this quarter for them. You know, what they did with the cash, what management say about the year ahead.
Yeah, absolutely. And Cintas, I mean, it's a huge player. Fortune 500, they're the ones helping, what is it, over a million businesses?
Over a million, yeah, helping them get ready for the workday.
Exactly. Uniforms, mats, first aid, safety, fire protection, all that fundamental stuff businesses need. They're really embedded in how businesses operate day to day.
And right off the bat, the headline numbers look, well, pretty strong. Revenue up 8.7%.
Solid.
And that profit flowed down too. Diluted EPS, earnings per share, up 9.1%. I mean, that's a strong quarter by any measure.
It really is. And it wasn't just strong, it looks consistent, efficient.
Okay, let's dig into that efficiency part first then. They reported $2.72 billion in revenue. That's up from $2.5 zillion last year.
Right.
So how much of that jump was, core business growth versus maybe just buying other companies?
That's always the key question, isn't it? So the total growth, like you said, 8.7%. But if we strip out the impact from acquisitions and foreign currency changes, sort of the noise.
The organic number.
Exactly. The organic revenue growth was 7.8%.
Wow. Okay. 7.8% organic for a company this size. That's really impressive.
It is. It tells you they're not just buying growth.
Right. They're actually winning business.
Winning business, selling more to existing customers, maybe getting better pricing. Acquisitions only kicked in about 0.9% of that total growth, so the core engine is humming.
That's a great sign. And it sounds like that operational strength, that humming engine, translated to profits too. Gross margin went up to $1.37 billion.
Yep. And the really interesting part there is the margin percentage. It expanded. Gross margin as a percentage of revenue went from 50.1% last year to 50.3% this quarter.
Okay, so a 20 basis point increase.
Precisely. It sounds small, 20 basis points, but
across $2.7 billion in revenue, that adds up fast. It means they're keeping a slightly bigger slice of each sales dollar.
Exactly right. Better cost control, maybe pricing power, likely a mix. And it wasn't just at the gross level. Operating income also saw strong growth, up 10.1% to $617.9 million.
Okay, and the operating margin, did that expand too?
It did, moved up to 22.7% from 22.4% last year. So that efficiency, that discipline, it seems to run through the whole operation, not just, making uniforms or delivering the services.
Got it. So the whole machine is running smoothly, efficiently. Now let's kind of pop the hood. Where is the power coming from within Cintas? Which parts of the business are really driving these strong results?
Right, let's look at the segments. The biggest piece, the one most people associate with Cintas, is still uniform rental and facility services.
That's the core, yeah. How did it do?
It brought in $2.091 billion in revenue. That's an 8.1% increase over last year. Still very solid growth.
And its margin?
Gross margin there was 49.7%. So huge segment, good margin, growing well.
But there's a but.
Well, it wasn't actually the fastest growing segment this quarter.
Oh, interesting. Which one was?
Their other services segment, this is the first aid, the safety, the fire protection business.
Okay, so the more specialized services, what did their numbers look like?
Revenue there was $627 million, roughly, but the growth rate was 10.4%.
10.4%. So noticeably faster than the uniform segment.
Yep. And critically, the gross margin was higher too. It came in at 52.3%.
Okay. So faster growth and better margins in that other services segment, that kind of reframes things a bit, doesn't it?
It does. It shows they're not just a uniform company anymore. They're really pushing into these higher value, specialized safety and facility services, and it's paying off in both growth and profitability.
Makes sense. And the CEO, Todd Schneider, he attributed the results to internal factors, right?
He did. He mentioned, let me see, disciplined execution, ongoing investment in technology and talent, and the unwavering commitment of our employee partners.
So they feel their own investments in tech and people are driving this.
That seems to be the message, that those investments are enabling them to execute, especially in those higher growth, higher margin areas.
Okay, great context. Now let's pivot a bit. They generated strong profits. What did they actually do with all that cash? Let's talk capital allocation.
Right. Always important to see where the money flows, and they seem focused on a balance between reinvesting and returning cash to shareholders.
Okay, shareholder returns first. Anything notable there?
Definitely. The dividend. They paid out $182.3 million. But the key thing was the increase. It was up 15.4% compared to the dividend they paid the previous September.
15.4% increase. Wow. That signals a lot of confidence from management, doesn't it?
Huge confidence. You don't typically make a dividend jump like that unless you feel pretty good about the future earnings power and sustainability of the business.
Were they buying back stock too?
They were, pretty actively actually. They spent $347.4 million buying back their own shares during the quarter and up through late September.
So big dividend boost and significant buybacks. That's management putting its money where its mouth is, suggesting they think the stock is a good value while also giving cash back.
Exactly. It's a strong signal.
Now, here's something interesting. The source mentioned that despite higher net income, free cash flow, which is a non-GAAP number management uses, actually went down a bit compared to last year.
Yeah, that can seem counterintuitive at first glance. Free cash flow was $312.5 million, down from about $367.4 million.
So profits are up, but free cash is down. Why the difference? What's going on there?
It really comes down to investment in the business to support that growth we talked about.
Yeah.
Two main things. First, they spent more on capital expenditures, or CapEx, $101.9 million this quarter, up from $92.9 million last year.
So investing in things like trucks, facilities, equipment, the stuff they need to grow.
Exactly. Pouring money back into the infrastructure. That uses cash now, which lowers free cash flow temporarily, but it's essential for supporting future growth.
Makes sense. What was the other factor?
Changes in operating assets and liabilities. Basically, needing more working capital. Think about it, with sales growing fast, they need more inventory, like uniforms ready to go. They might have more money tied up in receivables.
Right, the cash needed just to grease the wheels of a bigger operation.
Precisely. So less free cash right now because more cash is actively working inside the business to fuel that growth. It's not a sign of weak profits, just heavy investment.
That's a crucial distinction. Thanks for clarifying. All right, let's look ahead. Management didn't just report a good quarter. They actually raised their guidance for the full fiscal year 2026.
They did, showing that confidence extends beyond just Q1.
So what are the new goalposts they've set?
For annual revenue, they've raised the range to $11.06 billion to $11.18 billion. And for diluted EPS, the earnings per share, the new target is $4.74 to $4.86. So bumps on both the top and bottom lines.
They clearly see the momentum continuing. Now, guidance always comes with assumptions, the sort of fine print. What are the key ones here?
Yeah, there are a few standard ones, and one that's particularly interesting. The standard ones, they assume no big changes in foreign currency exchange rates.
Okay.
And no major future acquisitions baked into these numbers, so it's focused on organic performance.
Makes sense. Keep it clean.
They also noted that fiscal 2026 has the same number of work days as fiscal 2025, so that removes a potential calendar quirk from the comparison.
Right, standardizing the operating days. What's the more interesting assumption you mentioned?
It's about interest expense. They expect net interest expense to actually tick up slightly for the full year to around $97 million from $95 million last year.
Okay, why is that interesting? It's a small increase.
The reason they gave is interesting. It's, and I quote, primarily as a result of refinancing senior notes at a higher interest rate.
So even a really well-run, profitable company like Cintas isn't immune to the current higher interest rate environment when they have to roll over old debt.
Exactly. It's a real-world example of that pressure. Their operational margins are expanding, which is great, but they're simultaneously having to absorb higher financing costs on the back end.
It really highlights why that operational efficiency, that 20 basis point margin gain we talked about, is so important.
Yeah.
They need it to offset things like rising borrowing costs.
Absolutely. Oh, and one last assumption, they expect their effective tax rate to stay steady at 20.0%, same as last year, so predictability there.
Okay, this has been fantastic. We've really dug into the numbers and the strategy. Let's try to synthesize it all one last time for the listener.
Sure. So Cintas delivered a really strong Q1. You saw solid organic growth, that 7.8%, which is key. They managed to translate that growth into better margins. Remember that 20 basis point gross margin expansion.
Right.
That profitability allowed them to reward shareholders significantly, especially with that big 15.4% dividend hike. And they did all this while investing heavily back into the business, even as they're navigating, the reality of higher interest rates on their refinanced debt. It paints a picture of strong operational discipline.
So you, the listener, should now have a solid grasp of the financial levers Cintas pulled this quarter, where the growth came from, especially that faster-growing other services segment and how they're deploying their capital.
Which brings us to maybe a final thought, something for you to kind of chew on.
Okay.
Look, the company's performing well, but the source materials explicitly mention risks like rising labor costs, energy, and fuel costs. We saw the other services segment has great margins, 52.3%, and it's growing fast.
Right, outpacing the core uniforms segment.
Exactly. The big question moving forward, I think, is this. If those input costs, labor, fuel, really start to bite harder, can that high-margin other services segment keep growing fast enough to offset potential margin pressure on the much larger, slightly lower-margin uniform rental business?
So can the star performer carry enough weight if the main engine faces headwinds?
Yeah. Can that operational excellence the CEO cited continue to outpace those cost pressures across the whole business? That internal segment dynamic, that's probably the key thing to watch as they work towards hitting that raised guidance over the next few quarters.
A really interesting dynamic to keep an eye on. Thanks for breaking it all down. Until next time, keep digging.